Have you ever noticed how some investments just seem to do better at certain times of the year?
Yeah, for sure. There's this whole idea of like seasonal trends in the market.
Exactly. And I always think, wouldn't it be amazing if you could, get ahead of that curve?
Absolutely. It's like if you could anticipate those patterns, you could potentially make some really smart moves. It's called front running, basically. Like if you can get in before everyone else, before the trend really takes off.
Right. Think of it like buying winter coats in the summer, right? You're going to get a much better deal before everyone else needs them.
Yeah, perfect analogy. And that's exactly what we're going to be diving into today. We're going to be looking at whether this whole front-running thing, this idea of like anticipating seasonal patterns actually works, specifically in country ETFs, those exchange-traded funds that track the stock markets of different
Oh,
countries.
yeah.
It's really interesting stuff. It's an area where, there hasn't been a ton of research.
The goal today in this deep dive is to really understand, first of all, can you actually benefit from this? Like, can you anticipate seasonality in country ETFs? And if so, like, what does that look like in practice? But then also, are there any potential downsides?
Right, there's always a catch.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
So I guess let's start with the theory behind it. Like, how does this whole front-running seasonality thing actually work?
Okay, so the basic idea is if historically we see that an asset, let's say, the stock market of Brazil tends to perform well in, July, right? Maybe there's some recurring economic factor or some kind of investor behavior that happens every July in Brazil. The strategy suggests that you buy the ETF that tracks the Brazilian market in June.
So you get in before the rush, basically.
Exactly. The thinking is, as it gets closer to July, more and more investors are going to be like, oh, yeah, July is a good month for Brazil. I should get in on that. And their combined buying pressure is going to push the price up even further.
So you're already there, right? And you're ready.
Exactly. And so you can potentially profit from this thing called pre-seasonality drift, which is, that upward movement even before the main seasonal effect is expected to happen.
So it's all about riding that wave of anticipation.
Exactly. And, I think this is really important for our listener who's, really into grasping market dynamics, because it really shows you how expectations can actually move markets.
For sure. For sure. Expectations are a huge part of how markets move. So, all right, I'm curious about this research that you mentioned. How did they actually, test this out with country ETFs? What data do they look at?
Okay, so they took monthly performance data from 23 different country ETFs covering a wide range of markets.
Okay.
So they had developed nations like the UK with EWU and Germany, EWG, and emerging economies like Brazil, EWZ, and India, INDY.
Okay, so it was like a global look.
Yeah, a really diverse set of countries, which is important.
So what about the time frame? Like, how far back did this data go?
So most of the ETFs, the data started from the year 2000. A few of them, like the ETFs for South Africa, China, and India, they were launched a bit later, so the data starts a bit later.
Yeah.
But they included all the available data up until February of 2025. So they were really looking at this over, a pretty significant time frame.
Okay, so they have all this data for all these countries over a long period of time. How do they actually set up this front-running strategy? Like, how did they test it out?
All right, so here's where it gets interesting. So at the end of each month, they look back at the performance of all 23 ETFs in the same month of the previous year, so 11 months prior.
Okay.
So to figure out, let's say, what to invest in for April, they looked at how each ETF did in May of the year before. And they were looking for patterns. Like, if a certain country ETF consistently did well in May, maybe there's something there.
Right, so they're like, if history repeats itself, we could be onto something.
Exactly. So then they ranked all 23 ETFs based on that prior year's performance. So the top performer gets the #1 spot, and so on.
Okay, and then I'm assuming they invested in the ones that ranked the highest.
Yeah. But here's the thing. They didn't just put all their money in the top ETF. They tested out a bunch of different approaches to figure out how many of those top-ranked ETFs to include.
Oh, okay.
So they tried picking just the top 5%, then the top 10%, then 20%, 25%, 33%, and even 50%. So it's like, how much are you willing to bet on those top performers? And it makes sense, right? Because you don't want to go all in on just one, because what if that one has a bad year?
Right.
So, spreading it out a bit makes sense.
Okay, so they've got all these different strategies, all these different ways of picking the ETFs. But how do they know if any of it is actually working? Like, what are they comparing it to?
Right. They need a benchmark. So their benchmark was simply an equally weighted average of all 23 country ETFs. So it's like, if you just spread your money equally across all of them.
Okay, so it's like a passive approach.
Exactly. And that allows them to see if actively trying to front run those patterns actually beats just passively holding everything.
Okay, so they've got the theory, they've got the data, they've got all these different strategies. What did they find? Like, did it work? Did they make more money?
The results are pretty interesting. So for most of the time period they looked at, the majority of those front-running strategies, the ones that picked anywhere from 1 to 11 of the top ETFs, they actually did outperform that simple benchmark.
Wow, so it actually worked.
Yeah, it seems like, there could be something to this. However, there's a really important caveat here. The strategy that only invested in the top ETF, the #1 ranked ETF, that one had a pretty rough time after 2019.
Oh, so kind of like fell apart.
Yeah, it had a significant decline. And that really shows you the risk of, being too concentrated. If you're only betting on one horse and that horse stumbles.
You're in trouble.
Exactly. So diversification, even with this strategy, seems to be pretty important.
It always is, right? Don't put all your eggs in one basket.
Right. Okay, so they saw that being too concentrated is risky. What about the strategies that had more than one ETF? Like, was there a magic number that seemed to work best?
Yeah, like a sweet spot.
Yeah, exactly. And it seems like there might be. So the strategies that had the best results, the most consistent results, were the ones that picked between 3 and 8 of the top-ranked ETFs.
Okay, so not too few, not too many.
Right, like Goldilocks in the 3 ETFs. You want it just right.
Yeah. And just out of curiosity, like what percentage of the total ETFs is that? Like 3 to 8 out of 23.
Let's see. It's roughly like 13% to 35%. So a decent chunk, but not the whole pie.
Right. So it's like you're focusing on the strongest signals, but you're not putting all your eggs in one basket.
Exactly. And, to get even more stable results, the researchers actually averaged the performance of those 6 front-running strategies that picked between 3 and 8 ETFs.
Okay.
They called that their final strategy, kind of like a blend of the best performers.
Okay, so they're combining the power of all those different approaches.
Exactly. And, get this, that final strategy actually beat both the benchmark and the average of all 11 initial strategies.
So it's like diversification within the top performers is the key takeaway here.
Yeah, it seems to be the magic formula.
That's really interesting. But like with any investment strategy, there's got to be some downsides, right? Like some potential risks.
Oh, definitely. There's no such thing as a free lunch, right?
Right. So what are some of the things people should watch out for?
Okay, so as we saw with that single ETF strategy, concentrating too much can be really risky, right? Because if something goes wrong in that one market, you're in trouble. But on the flip side, if you include too many ETFs, you might dilute the benefits of focusing on those top performers. You're spreading yourself too thin, and you're not taking full advantage of those strong historical patterns.
Yeah, it's like a balancing act.
It really is.
Okay, so concentration risk, dilution risk, anything else?
Okay, so this is important. The research actually found that the strength of this pre-seasonality drift
Yes.
is not the same across all asset classes. They saw that it's strongest in commodities. But for country ETFs, it seems to be a bit weaker.
Why is that?
They think it's because, country ETFs mostly hold stocks, equities, and equities historically, they have this general upward trend.
Right.
So that long-term growth can sometimes overshadow those shorter-term seasonal patterns.
It's like the bigger trend is kind of masking the smaller trend.
Yeah, exactly. Whereas commodities, they don't typically have that same consistent upward trajectory.
Yeah, they're more volatile. Right.
Right, so those seasonal patterns might be more pronounced.
Okay, that makes sense. So it's like different asset classes, different dynamics.
Exactly. And, something else to keep in mind, all this analysis, it's based on historical data.
Right.
And as we all know, past performance is not necessarily indicative of future results. Market conditions change, investor behavior changes. What worked in the past might not work in the future.
Yeah, that's always something to remember. So, okay, let's summarize. Like, what are the key takeaways for our listener from this whole deep dive into front-running seasonality in country ETFs?
All right, so the main takeaway is that if you look at how country ETFs performed in the same month of the previous year, and you pick, let's say, 3 to 8 of the top performers.
Right, the sweet spot.
Right, that sweet spot, and you invest in those. Historically, you could have potentially done better than just passively holding all of them.
Okay, so there's potential there.
But there are risks. Don't get too concentrated. Don't spread yourself too thin. And remember that this strategy might not be as powerful in country ETFs as it is in other asset classes, like commodities.
Right, so it's all about balance and understanding the nuances. Really interesting stuff. It's a big world out there, and it's full of possibilities. So keep exploring, keep digging. You never know what you might find. And that's all the time we have for today. Thanks for joining us for this deep dive.
Thanks for listening.
We'll see you next time.